Hey everyone, interest rate cuts are coming. According to FOMC participants, there could be several interest rate cuts coming in 2024 and even more coming in 2025. So what are good investments to make when interest rates are falling? Well, in this video, I'm going to argue that growth stocks are a good investment to make, and I'm going to highlight 3 specific growth stocks that I think make an excellent investment according to what is expected to happen in Federal Reserve monetary policy in 2024. Of course, there's more factors to consider. In this video, we'll highlight some of those factors as well. So let's get right into it. Let's see what these 3 growth stocks are. Let's see about these interest rate cuts.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so what you're looking at on screen is FOMC participants' assessment of appropriate monetary policy, the midpoint of the target range or target level for the federal funds rate. So what you'll notice here for 2023, all 19 participants penciled in that they want or they think that the midpoint of the target range or interest rate should be 5.375%. And of course, if this is what they're penciling in as what they think is appropriate, when they go to vote on monetary policy, this is likely to be their vote. Now, interestingly, look at how it changes for 2024. You can see only 2 FOMC participants feel it appropriate to have interest rates this high. One thinks it should be at 5.125. 5 participants think it should be at 4.875. 6 participants think it should be at 4.625. 4 think it should be 4.375. And 1 thinks it should be as low as 3.875. The average rate, I would say, the roughly average could be around 4.75%, which would be about 50 basis points below where we're at right now. So about between 2 to 3 interest rate cuts. In fact, my estimate for 2024 is that the Federal Reserve will cut interest rates by 3 times by 75 basis points in total. So 3 25 basis point cuts in 2024 is my base case assumption for 2024. Now, look at what is indicated for 2025. Even more rate cuts, even lower interest rates for 2025. Participants feel that 3.875, 3.625, 3.375, 3.125 would be more appropriate, and I would estimate that there would be an additional 4 to 5 interest rate cuts coming in 2025. Now, it's too early to say that, but from this picture, that's what it looks like. Now, I will make my estimates again towards the end of the year. When this dot plot comes out again for 2025, I'll readjust my estimate, but it looks like there's more cuts coming in 2025 and then even more in 2026. And in the longer run, even more for the interest rate. You see here for the longer run expectations, 8 participants out of 19 think that 2.5% is the appropriate monetary policy to maintain. Now, what that means, the longer run appropriate policy rate expectation, is the rate that they think is neither increasing economic activity or decreasing economic activity. It's the interest rate that keeps the economy at equilibrium. Right now, our current monetary policy is restrictive, meaning it's trying to slow down economic activity. Why would the Federal Reserve try and slow down economic activity? Well, that's the primary way they bring down inflation. And unless you've been sleeping under a rock the last few years, you know that inflation has been a primary problem in the economy. So that's why they're holding monetary policy restrictive to try and bring down inflation. And that's why in the longer run, they think it should be down to 2.5%. So in other words, there's interest rate cuts on the way, and they'll start to come in 2024, more in 2025, more in 2026 to work its way down to the appropriate longer run interest rate of 2.5%. So that being said, I want to demonstrate to you two different scenarios, right? You have a growth company and you have a mature company. The growth company is going to increase its cash flow over time. The mature company, you'll notice, is relatively stable in the cash flow, around 50. The growth company is increasing the cash flow over these years projected. Now, these values here, the present value of the cash flow, takes all of these cash flows, uses the time value of money concept, and gets a net present value of the cash flow at $250 for the growth company, $252 for the mature company, and this is assuming an interest rate of 5%, a discount rate of 5%. So what I want to demonstrate to you is what happens, the changes in these values when I change this interest rate lower, which is what we're expecting in the economy, right? I just spent the first 5 minutes or so of the video highlighting that interest rate cuts are coming. So if interest rate cuts are coming, let's see how it's going to impact these hypothetical companies, a growth company and a mature company. So I'm going to lower this interest rate from 5% down to 2%. And let's see how these valuations change. Look at that dramatic change in valuation. You notice now the growth company is worth significantly more than the mature company at $292 compared to $278. Let me go back so you can see the difference in action. From $250 up to $292 and from $252 up to $278. So interestingly, both companies are expected to increase in valuation because of lower interest rates. That's typically the relationship. I teach this at university, and that's one of the primary learning objectives I try to get across to my students every semester, is that when interest rates go down, that generally has an inverse relationship with asset prices, and asset prices go up. So interest rates go down, asset prices go up. That's a long-term relationship inverse that holds for nearly every asset class, whether it be real estate, stocks, bonds, etc., etc. And so you're seeing that here, why that's the case, because when you're using the time value of money concept, it increases the valuation of those cash flows in the future. So what are three stocks we can buy that will benefit from this expected increase in growth stock valuation? One of these growth stocks that you can buy, and now I'm assuming you want to spend less than $100. I'm going to assume you want to spend less than $100 on each stock here. So the first one I'm going to highlight is Palantir at a price of $16.42. And valuation-wise, Palantir is also attractive at a forward price to earnings of 46.13. The difference between market price and price to earnings is price to earnings measures what you're getting for the price you're paying. It's like when you go to a supermarket and you look at the different sizes of Coca-Cola. You have a 12-ounce can that's selling for $1, and you have a 24-ounce bottle that's selling for $1.50. The calculation that you're probably doing in your mind when you're deciding which one to buy is the price per ounce. How much are you paying per ounce of Coca-Cola? When you do that calculation, you realize the 24-ounce bottle gives you a better value for your money. That's the same thing with stocks. The market price is the price you're paying. The price to earnings is the value you're getting. So the higher the price to earnings, the more expensive a stock is. And the reason why I like Palantir, one of the reasons why I like it, in addition to, of course, it's one of the leading companies in artificial intelligence, but it's also been increasing sales while also increasing cash flow. Here I have the cash flow from operations to sales in the trailing 12 months, and you can see it steadily rising from 8% in 2021 all the way up to 23% in the most recent year. The next stock I'm going to highlight at $37.72 per share is Pinterest. Pinterest is another growth stock that I think will benefit in 2024. It's selling at a forward price to earnings of 22.97. You can see again, it's different from the market price. And Pinterest also, cash flow from operations in the trailing 12 months, 13.99%. Although it doesn't have that straight upward trend, the overall sum at 13.99% is solid, and given Pinterest rate has made some job cuts and cost cuts in recent years, I think Pinterest will do well in increasing profitability over the next few years. And finally, Uber Technologies at a market price of $60.32, a forward price to earnings of 23.28. And you can see Uber's cash flow from operations to sales rising nicely from negative 25% up to 7%. And given people's desires to unleash pent-up demand for away-from-home activities, Uber's ride segment is benefiting from that trend, while its food delivery segment is surprisingly thriving even though restaurants have reopened. So it's got this 1-2 punch of growth working for it. And that's why I'm recommending Uber as the last one of these 3 growth stocks that can benefit as the Federal Reserve plans interest rate cuts in 2024 and 2025. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.